Well, here we are in your mailbox again this week for your market update. This is Nolan McIntosh with McIntosh and Associates. Well, the Gulf heats up and the GDP cools down. After a pause in the bombing campaign to allow for room for talks, hostilities resumed after Iran tried and failed to attack U.S. military personnel in the region. The story varies depending on which side you listen to, but the disposition of the Iranian administration clearly is not changing, so the U.S. ramped up its bombing campaign back up. Predictably, oil spiked back up into the 85 per barrel range after declining the week before, leading to higher market volatility as the conflict reignited. All this turmoil had impacted on the second quarter gross domestic product, which came in at 1.5% actual versus the forecasted 2%. The lower than expected number doesn't necessarily mean the economy is in trouble, because there was some good news under the surface. Core real GDP, which includes consumer spending, business fixed investments, and home building, and excludes more volatile categories like governmental purchases, inventories, and international trade, grew at 3.9% in the second quarter, the fastest pace in more than 3 years. It's now up 2.6% from a year ago. Inflation continues to be a problem, more of that in the next section, largely due to the oil prices. The sooner the situation in Iran is resolved, the better it will be for all concerned. Well, markets smell rate increases by year end. At the second Federal Reserve meeting chaired by Kevin Warsh last week, the Fed maintained the federal funds target range at 3.5 to 3.75%, in line with consensus expectation. There's only one key change in the Fed statement, which made it clear there is sentiment to raise rates if the inflation picture does not improve. Then at the post-meeting press conference, Warsh made it clear the Fed is committed to achieving the 2% inflation target. There's more dissent within the committee, with 3 of the 12 members voting to raise rates 1/4 of 1 point. There seems to be a rising chorus of rate hawks. One of the interesting side notes was that former Chair Jerome Powell voted with the majority to keep rates where they are, so all the Fed drama queens, Machiavellians, and other conspiracy theorists didn't get to wallow in some of our official storyline. But just to put in a tiny drop of gasoline on the fire, the 3 bank presidents who voted in favor of raising rates were appointed by Powell. Interesting. Powell did what he always done, whether we liked it or not, and is once again waiting for more data before he changes his stance. There are only 3 Fed meetings left in 2026, and markets are expecting at least 1/4 point increase by December meeting. Markets didn't react well at the conclusion of last week's meeting, and we had a nasty little sell-off on Wednesday before recovering on Thursday. This time, pretty much everyone thought rates would remain where they were, but Warsh's approach to communicating, or the lack thereof, the Fed's next moves will take some getting used to. There will be reduced forward guidance, so more people will come to difficult conclusions around intent, and that will certainly add to the volatility. Then there's the increased disagreement between policymakers that will create greater uncertainty, especially if they're vocal when they are making the speaker rounds. This could also result in heightened volatility and more variable market expectations. Investors should be prepared for a less predictable policy environment. The 10-year Treasury yield jumped to around 4.7% last week before retreating in line with this assessment. Personal consumption expenditures, the Fed's preferred measure of inflation, came in at 3.7% for June, down from 4.1% for the prior month. That would seem to support the Fed staying put, but that improvement was almost entirely on the back of declining oil prices, which have since reversed. Watch the improvement evaporate as the oil prices rise and rematerialize with oil prices decline. The longer oil prices stay elevated, the stickier this inflation environment will get. We will just get used to the new normal, just like we got used to the new $2 and $3 gas. Once we normalize to higher gas prices, everything else that seems expensive will seem normal too. Well, coming this week we will look forward to the July jobs picture. Jobs have been mostly solid over the last couple of years, despite all the ups and downs in the economy. If jobs start to weaken, that could signal changes for the economy as we head into the year end. Data starts to roll in today with the job openings and labor turnover summary for June. Openings in May were 7.6 million, and expectations are that they will drop to 7.5 million for June. Fewer openings are never a positive sign. On Wednesday, the ADP National Employment Report is expected to come in at 65,000, a dramatic drop from the 98,000 reported in June. MBA mortgage applications will be the other interesting data item for the day. Thursday will be quiet as we await the big jobs data on Friday. Weekly jobless claims have been running at about 200,000 per week pace. Last Thursday was 197,000. A dramatic increase would be problematic, and the Bureau of Labor Statistics employment situation, aka the July non-farm payroll report, will be out on Friday. The unemployment rate stood at 4.2% last month, but only 57,000 new jobs were created. We need to rebound to about 100,000 new jobs, or grumblings of economic weakness will get louder. We'll also get hourly earnings, and we'll see if wages are keeping up with the inflation. Second quarter earnings reports are in full swing, with 61% of S&P 5 companies reporting results. So far, 86% of those companies have stated positive earnings per share, and 77% have reported positive revenue. Earnings growth for Q2 for the S&P 500 is 47.4%, up from 27.7% last quarter. If 47.4% is the actual growth rate for the quarter, it will mark the highest earnings growth for the index since the third quarter of 2021. This is shaping up to be a great quarter for earnings. For the current quarter, 20 S&P 5 companies have issued negative EPS guidance, and 34 have issued positive guidance. Valuation is near historical averages, and the S&P 500 with the forward 12-month price-to-earnings ratio at 19.6 versus 21.4 last quarter, down mostly due to stock market's performance in March after the turmoil in the Middle East. Well, that was a lot of information, but this is it for your market update for this week. We'll be back in your mailbox next week. As always, any questions, give us a call at 989-692-2200, and a lot of information on our website at focuswealthplan.com. Have a great rest of your week.